Ray, this week the Federal Reserve is going to meet to raise interest rates. This uncertainty in the market around when the timing of the interest rate rise is going to happen has created a lot of market volatility. I know you and the Cammack Retirement Investment Team have been working on looking at that volatility, and you've actually created a VIX chart, a volatility chart. Can you talk a little bit about the experiences you had with clients, kind of explaining what's going on in the market and what that means long term?
So with all this uncertainty comes volatility in the market. What we've seen, and we've looked back historically, when there is periods of volatility, yes, typically equity markets underperform. But what we can't put a finger on is when the volatility is going to end and when's the time if you were to try and time the market to get back in. What we've seen, and this is what typically works well for a retirement plan, is during periods of volatility, stay the course. If you're a long-term investor, you've got to believe in your long-term investments will pan out. And historically, when there's periods of volatility, yes, the equity markets take a little bit of a nosedive or a downturn, but they turn around. As we've seen just in the last quarter, the markets were down 6%. The S&P was down 6% third quarter. Month of October, right back up 8%. If you were to try and time the market, you would not have known when to get back in. And that's the biggest concern.
So two issues here, really. The plan sponsor has to understand that the impact of the market volatility, and that over time it kind of smooths out when you look at things in totality. Secondly, the plan sponsor's responsibility to communicate effectively to plan participants. So there's a statutory requirement as part of ERISA to communicate and educate, or if you're not in an ERISA plan, you follow best practices to educate people generally speaking. But people have a tendency to overreact. So I'm sure they're calling call centers, they're speaking to the plan sponsor, human resource benefits department about what to do. It's about urging calm, but not providing advice. So there's that balancing act.
And I think as long as the plan sponsor has created a lineup, has a diverse lineup, has a wide variety of asset classes, has a target date fund, I think they've got all the bases covered in terms of diversification, and the participants should be fine. Really, the plan sponsor, all they can really do is try and manage the fund, give appropriate, good performing investments, diversification, and also work to keep costs low. If they do that, they pretty much laid the groundwork for long-term success for the participants.
And when you and the team are doing your manager due diligence, and you guys do this all day long, every day of the week, when you find an issue, you're raising it, you're bubbling it up, and you're letting the plan sponsor know. So the plan sponsor should feel reassured that if they're working with an advisor and a consultant, they should understand and ask whether or not that advisor or consultant is really going to give them information ad hoc as needed. So if you identify an issue, Ray, you're bringing that to light. And I know you've done that in months past.
Constantly on top of all the managers. We're meeting not only weekly, sometimes daily with some of these managers just to get updates as to what's going on with the funds. Our biggest concern has been when there is some type of disruption or change in process and philosophy. And what we like is that managers, or we like fund managers who provide open communication, provide attribution, provide outlook, provide some insight, are able to get them on the phone to discuss things. It's the other fund companies that say maybe don't follow the benchmark or aren't as open with the communications or attribution. Those are funds that we have more of an issue with.